Imagine waking up to find that the cost of filling up your car has skyrocketed overnight, that the price of your weekly grocery shop has soared, and that your dream holiday is now a distant, unaffordable fantasy. That is the reality we could be stepping into if oil prices cross the $100 per barrel mark, a milestone that's more than just a number.
Oil prices could hit $100 a barrel soon.
Crude's trying to make a run for 100.
We're above $100 a barrel.
I think we're going above 100.
It's the start of a ripple effect that could see every aspect of our daily living costs surge even more than they already have. So, in this video, we'll take a deep dive into the world of oil, look at what moves its price, and outline the bullish and bearish cases for oil reaching $100. Let's fill up the tank and get going, shall we? First up, some context. There are many types of oil. When you hear pundits talking about the price of oil, they are typically talking about Brent crude, which is an international benchmark for pricing crude oil. You might also have heard of the similarly priced West Texas Intermediate, or WTI, which is the US benchmark for pricing oil. Both types are light crude oils with low sulfur content, making them ideal for refining into gasoline, which powers your car, and diesel, which powers heavy machines and vehicles, and many older cars, of course. Oils that are heavy and have high sulfur content are hard to refine. That's why they're typically used for lower value products like asphalt and fuel oil. Now, there's a whole spectrum of oil types and uses, but we don't need to get into all that here. Now, the $100 a barrel price of oil is widely talked about because, well, 100 is a mental marker and a big psychological milestone for investors and consumers. Also, climbing oil prices have major implications for the global economy, driving up the cost of everything from plane tickets to bread. And if oil gets pricier, we could see inflation going up as a result. This is likely to make central banks keep interest rates high. For now, though, back to prices. As you can see from this chart, Brent crude was last above $100 in August 2022. Meanwhile, this chart shows that the price of Brent crude began to climb from late June onwards, reaching the mid-90s in late September. Prices have since dropped to the low 80s at the time of filming this video. Where it goes next is anyone's guess, but everyone's concern. But before we look at the bullish and bearish cases for oil prices, there are a few more things you need to know about oil. First off, what affects the price of oil? Well, while you might expect oil prices to be set solely by the principles of supply and demand, in reality they're set in the oil futures market. In other words, they're set by the expectation of future prices or future predictions of supply and demand. Now, a whole host of factors can affect supply, or supply predictions. For the sake of brevity, I'll mention just two: geopolitical factors and OPEC. Unsurprisingly, conflicts, natural disasters, and other major geopolitical developments can disrupt the oil supply. For instance, Brent crude dropped to lows of $19.33 at the height of the pandemic in April 2021. On the other hand, the last time we saw a spike in oil prices was last summer when they reached just over $120, largely due to Russia's invasion of Ukraine. The ongoing conflict between Israel and the Palestinians? Well, I'll get to that a bit later. For now, though, let's turn our attention to OPEC, the Organization of the Petroleum Exporting Countries, a coalition of 13 oil producers that banded together to set oil prices. Collectively, they control about 40% of the world's supply of oil and hold approximately 80% of the world's crude reserves. Saudi Arabia is a leading member, commanding about 1/3 of OPEC's total reserves and wielding considerable influence within the group. In 2016, 10 other oil producers, including Russia, formed an alliance with OPEC to become OPEC+. This move was prompted by plummeting oil prices, which were in turn propelled by the US's surging production of shale oil. The US, I should note, is not a part of OPEC. It is, however, now the world's largest oil producer, followed by Saudi Arabia and Russia. So then, why did oil prices jump 30% since June before dropping back to the mid-80s this past week? Well, the initial surge can be attributed primarily to two factors. The first is a deliberate reduction in supply. Notably, Saudi Arabia and Russia intentionally curtailed production to elevate prices. This strategic cut, amounting to 1.3 million barrels a day, is slated to persist until the year's end. To provide some perspective, Saudi Arabia's oil production for November and December is projected at approximately 9 million barrels per day, or BPD. Although Russia's current figures are not publicly disclosed, its typical output before these cuts was between 9 and 10 million BPD. Now, the second influence is an uptick in demand, spurred notably by increased travel. A record surge in Chinese tourism and business travel over the summer, part of a global resurgence in mobility, stimulated a heightened need for petrol and kerosene. Global demand for so-called mobility fuels has remained robust, showing a growth of nearly 1.6 million barrels per day this year. Daily global flights, as of the week ending 29th of September, were recorded at 96% of 2019 levels, marking their highest point since mid-July and indicating a revitalization of both international and domestic air travel. However, the subsequent decline in oil prices is attributed to several complex factors. Some analysts point towards profit-taking by traders. Others, like oil analyst Paul Sankey, believe that Saudi Arabia, quote, pushed the price too high, and that the crash is due to a range of factors, including lower demand and the strength of the US dollar. Let's look at that more closely. First, high inflation in the US is putting downward pressure on oil prices. Although the US has so far avoided what many see as an inevitable recession, growth is nonetheless slow. With a rise in the cost of goods, purchasing power drops, which translates to a drop in demand for, and therefore the price of, oil. At the same time, the US central bank, the Federal Reserve, has been increasing interest rates in an effort to increase the cost of borrowing and thus reduce inflation. This appears to be working, though it is also increasing the value of the US dollar. And as a result, oil has become more expensive globally. So, why has the US dollar gotten stronger? Well, due to those higher interest rates, financial products associated with dollars, including US government bonds, are yielding higher returns. Now, bonds are similar to loans where governments or businesses borrow money from investors and vow to return it with interest. US government bonds are viewed as the safest investment there is. Recently, more people around the world have been buying US bonds, and for this, they need to spend dollars. This means that there is a higher demand for the dollar, making it stronger. When people buy more dollars and sell other currencies, the value of those other currencies goes down. In times when the economy isn't doing well, investors often choose to put their money in dollars because the US economy is seen as stable, making the dollar's value rise even more.
Sorry to interrupt you folks, but I have to let you know about the Coin Bureau deals page. Now, my team and I have been able to pull together some of the best promos and discounts in the crypto space. We're talking trading fee discounts of over 50%, thousands of dollars in bonus airdrops, amazing deals at top exchanges, reduced prices on hardware wallets, and much, much more besides. So just go to coinbureau.com/deals, also linked to below, and find the promo suited to you. Enjoy the rest of the video.
Now, looking forward, the complex interaction between rising US interest rates, which strengthens the dollar and in turn makes oil more expensive on a global scale, and the dynamics of oil supply and demand will play a pivotal role. At the time of filming, some analysts are still predicting oil prices could reach $100 by the end of the year. However, their numbers and conviction have dwindled in comparison to a fortnight ago when oil prices exceeded $90. Given that prices have now retreated to the 80s, envisioning a leap to 100 seems much less likely. As highlighted by The Economist, a production surge from non-OPEC countries is anticipated as the new year dawns. This augmented supply is projected to exert downward pressure on prices in the medium term. But what about those geopolitical factors? How, for instance, does a war in the Middle East, where 48% of the world's oil reserves are located, impact the price of oil? The short answer is that it's unlikely to significantly impact prices so long as the war is contained. Israel and the occupied territories are not major oil players, though Israel does boast 2 oil refineries with a combined capacity of almost 300,000 barrels per day. And neither is neighbouring Lebanon, where on the 8th of October the militant group Hezbollah launched attacks on 3 Israeli targets, raising fears of a widening conflict. However, if the war were to spill over to a regional conflict involving Iran, which backs Hamas and Hezbollah, and the US, which supports Israel, this could spook the markets and drive up prices. This, then, is the key development to watch out for. And what about OPEC? In 1973, Arab OPEC states stopped shipments to the US and several other countries in retaliation for supporting Israel during the Yom Kippur War, also known as the Fourth Arab-Israeli War. Could they do this again? Well, anything is possible, but it's highly unlikely. Relations between Arab states and Israel have improved markedly since the Yom Kippur War. The Abraham Accords in 2020 brought peace between Israel and 4 Arab states, including 2 OPEC members, the United Arab Emirates and Bahrain. Also, peace talks have been ongoing between Israel and Saudi Arabia, OPEC's leading member. And finally, even if OPEC considered an embargo, it wouldn't have nearly the same effect as it did in the 1970s, since the US is now the biggest oil producer in the world. So, although oil prices could rise above $100, it's unlikely. Which is all the better, frankly. I don't know about you, but inflation and so-called shrinkflation, which we're covering in an upcoming video, are bad enough as it is. $100 for a barrel of oil is something almost everyone, bar a few already wealthy oil producers, could well do without. And that's about it for today, my friends, but what do you think? Will oil hit $100, or are those bullish predictions overblown? Before you go, if you enjoyed this video and learned something from it, please like it, share it, and make sure you subscribe to both Coin Bureau and Coin Bureau Clips. Also, head on over to the Coin Bureau Deals page where you can find the best discount deals and finest crypto merch there is. It all helps support our channel and lets us continue to provide you with the best crypto and macro content out there. So, until next time, this is Guy bidding you goodbye.